People assume January is a reset. They believe the calendar wipes away stress, clears positioning, and gives markets a clean slate. That belief is comforting, but it is wrong. Markets do not reset because the year changes. They carry pressure forward. December hides it. January exposes it. And silver is entering January 2026 with pressure that has been building quietly for years, not weeks. Throughout December, markets behave unnaturally. Trading desks reduce risk. Liquidity thins. Price discovery weakens. Decisions are delayed, not resolved. Tax considerations distort behavior. Portfolio managers protect appearances instead of confronting reality. This creates a false calm, especially in assets where stress exists beneath the surface. Silver is one of those assets. It is not just a traded instrument, it is a physical input for the global economy. And physical demand does not care about holidays, fiscal years, or calendar transitions. When January begins, this artificial calm disappears. Mandates reopen, capital allocations restart, risk limits reset, procurement schedules resume. Suddenly, positions that were acceptable in December become urgent in January. This transition is not gradual. It is compressed into the first few trading sessions. That compression is why January matters more than people expect, especially for commodities with constrained supply. Silver does not respond to optimism or sentiment the way equities do. It responds to availability. It responds to delivery. It responds to whether metal can be sourced when needed. This is why January is dangerous. Deferred demand does not disappear. It accumulates. And when the calendar flips, that demand returns all at once. A common mistake investors make is assuming that January pullbacks are natural and healthy. Sometimes they are. But that assumption breaks down when a market is already tight. In tight markets, pullbacks often reflect temporary paper selling into environments where physical buyers are waiting. Those buyers are not speculative. They are mandated. They cannot wait indefinitely. When they step in, price recovers faster than expected, leaving those waiting for confirmation behind. Silver enters January 2026 after multiple years of cumulative supply deficits. This is not a single-year imbalance that corrects itself quickly. Mining output has not kept pace with consumption. Recycling fills only a portion of the gap. Industrial demand from solar energy, electric vehicles, electronics, and grid infrastructure continues to grow. This demand is not price sensitive in the short term. Factories do not stop production because silver is expensive. They stop when silver is unavailable. That risk becomes visible when procurement cycles restart, not when markets are quiet. December often disguises this reality. Futures markets appear stable, volatility compresses, headlines fade. But none of that changes the underlying math. Contracts still exist, deliveries still need to be honored, hedges still need to be rolled. When January arrives, these obligations reemerge. In a market like silver, which trades thin relative to global demand, this reemergence magnifies price movement. There's also a psychological component that is frequently misunderstood. January is often described as a month of confidence. That description fits risk assets during expansionary cycles. Precious metals behave differently. They respond to doubt. They respond when confidence weakens. The environment entering January 2026 is not one of certainty. Debt levels remain elevated. Monetary policy paths remain unclear. Geopolitical tensions persist. Supply chains remain vulnerable. This backdrop favors assets that hedge uncertainty, not assets that depend on optimism. Another misconception is that January volatility requires news. It does not. Structural moves often occur without headlines. They occur because the system reactivates. Liquidity returns unevenly. Sellers become cautious. Buyers become urgent. That imbalance creates price movement that appears sudden but is actually delayed. Historically, some of silver's most important moves have occurred early in the year. Not because January is special, but because January removes the tools that suppress volatility. When desks are fully staffed, risk managers are present, and capital is active. Unresolved stress surfaces. That stress expresses itself through price. Silver's dual role makes this effect stronger. It is both a monetary metal and an industrial commodity. When financial uncertainty rises, investment demand increases. When industrial production expands, consumption increases. These forces can act simultaneously. January is when both tend to activate together. Many investors focus on charts during this period. Charts are reflections, not drivers. The real drivers are settlement, procurement, allocation, and inventory management decisions made quietly before price reacts. When silver trades strongly in the first week of January without obvious catalysts, it is often because those decisions were already made. Physical premiums are especially important during this time. If price rises but premiums remain elevated, it signals real scarcity. If price dips but premiums do not fall, it suggests sellers are unwilling to part with metal. These signals matter more than daily candles. January 2026 should not be approached as a seasonal opportunity. It is a structural checkpoint. It is a moment where mispricing is tested against reality. Silver has been mispriced relative to its role in demand for an extended period. That mispricing has not disappeared. It has been deferred. The danger for investors is assuming that January will behave like prior years without considering context. Context matters. Supply constraints matter. Industrial dependence matters. Market structure matters. Silver is not entering January from balance. It is entering January from strain. This is why waiting for clarity often results in missing the move. Clarity usually arrives after adjustment. Silver does not announce transitions. It forces them. January. As first week is when the market answers a simple question. Can current pricing absorb returning demand? If the answer is no, adjustment begins quickly. If the answer is yes, pressure builds for later release. Either outcome matters. This part is not about forecasting a specific price level. It is about understanding timing and mechanics. Investors who treat January as calm often find themselves reacting instead of positioning. Silver does not reward hesitation during structural moments. As the year opens, the signals will not be loud. They will be subtle. How silver trades on low volume, how quickly dips are absorbed, whether physical availability tightens or loosens. These are the indicators that matter. In the next part, the focus will shift to institutional behavior. How funds deploy capital at the start of the year, how industrial buyers secure supply, why January allocation decisions can lock in trends that persist far longer than expected. This is not entertainment, it is system behavior, and systems reveal themselves when pressure is no longer hidden. January exposes institutional behavior because institutions cannot wait. Retail investors can sit on the sidelines, but institutions operate under mandates, contracts, and operational constraints. When the calendar resets, these constraints reassert themselves immediately. This is especially true in commodities like silver, where institutions are not trading for speculation alone, but for hedging, procurement, and balance sheet protection. By the time January begins, most large players already know their exposure. What changes is their tolerance for carrying it. One of the most important facts about silver entering January 2026 is that global supply has been running at a deficit for multiple consecutive years. According to industry data compiled from mining output, recycling, and consumption estimates, the silver market has experienced annual deficits ranging from roughly 100 to 200 million ounces per year since the early 2020s. These deficits did not disappear. They were filled by above-ground stockpiles. Those stockpiles are finite. When stockpiles shrink, the market becomes sensitive to even modest increases in demand. Industrial demand alone consumes more than half of annual silver production. Solar panel manufacturing, electronics, medical equipment, automotive electronics, and grid infrastructure all rely on silver's conductivity and durability. In 2025, global industrial silver demand was estimated at over 700 million ounces, with solar accounting for roughly 200 million ounces by itself. That number continues to grow as photovoltaic installations expand globally. None of this demand is discretionary in the short term. Factories do not scale production week by week in response to spot prices. They operate on quarterly and annual plans. When procurement cycles restart in January, the metal must be sourced regardless of price. Institutional investors also re-enter the market with fresh capital allocations. Pension funds, endowments, insurance portfolios, and large asset managers typically rebalance at the start of the year. Even a small percentage allocation shift into precious metals represents billions of dollars. Silver, because of its smaller market size compared to gold, reacts more violently to these flows. The total value of annual silver production is tiny relative to global capital markets. This is why marginal capital has outsized impact. Another structural factor that becomes visible in January is futures positioning. Throughout December, many traders roll contracts forward to avoid year-end delivery and reporting. This creates the illusion of reduced pressure. When January arrives, delivery expectations reemerge. Those holding short positions must either deliver metal, source metal, or buy back contracts. In a market where registered inventories are already under strain, this creates competition for a limited pool of available ounces. Inventory data illustrates this clearly. Exchange-tracked silver inventories, including those associated with futures markets, have shown persistent drawdowns during periods of heightened demand. While headline numbers sometimes fluctuate, the critical metric is deliverable metal, not total reported inventory. Much of the silver counted in inventories is already allocated, pledged, or backing financial products. What matters is what can actually be moved. That pool has been shrinking. Physical premiums provide another real-time signal. When paper prices soften but premiums remain elevated, it indicates that sellers are unwilling to part with metal at quoted prices. This phenomenon has been observed repeatedly during periods of stress. In late 2025, retail and wholesale premiums remained historically high, even as futures prices fluctuated. This divergence is not speculative behavior. It reflects physical scarcity. January also reactivates industrial procurement contracts. Large manufacturers often negotiate supply agreements at the beginning of the year to secure inputs for the coming quarters. These agreements are frequently off exchange and invisible to public price feeds. When refiners and wholesalers allocate metal to fulfill these contracts, that metal never reaches the open market. It quietly reduces available supply. This is one reason why visible inventories can drop, even when prices rise. The metal is being intercepted before it reaches exchanges. Geography matters as well. Silver does not trade as a single unified market. Regional pricing differences emerge when supply chains tighten. When one region is willing to pay more for immediate delivery, metal flows toward that region. Arbitrage normally keeps prices aligned, but arbitrage depends on available transport, willing sellers, and accessible inventories. When those conditions weaken, price gaps persist. January is when those gaps tend to widen because demand accelerates faster than logistics can respond. Currency dynamics add another layer. Precious metals are priced in fiat currencies, but they are not liabilities of any government. When confidence in currency stability weakens, metals attract defensive flows. Entering 2026, global debt levels remain historically high, and central banks face conflicting pressures between inflation control and economic growth. Even the expectation of future rate cuts can increase interest in non-yielding assets like silver, especially when real yields compress. January is when expectations are repriced. Another often overlooked factor is the behavior of bullion banks and market makers. These institutions provide liquidity, but they also manage risk tightly. When volatility rises and inventories tighten, their willingness to make markets decreases. Bid-ask spreads widen. Order books thin. This does not require a crisis headline. It happens mechanically when risk exceeds tolerance. January reintroduces full participation, but it does not guarantee full liquidity. In fact, it often exposes how little liquidity actually exists. Historical patterns support this. Some of the most abrupt silver moves have occurred during periods of low apparent news flow but high structural tension. In these moments, price jumps are not driven by enthusiasm, but by necessity. Someone must buy, someone must deliver, someone must cover. Price becomes the clearing mechanism. Mining supply cannot respond quickly to these dynamics. The majority of silver production is a byproduct of mining for other metals such as copper, lead, and zinc. Even if silver prices rise sharply, production cannot be increased unless base metal output increases as well. This makes silver supply relatively inelastic in the short and medium term. January, demand therefore hits a supply curve that does not bend. Recycling provides some relief, but not enough to offset deficits. Recycling output depends on collection, processing capacity, and economics. While higher prices incentivize recycling, the volumes recovered are limited and slow to respond. Recycling cannot suddenly deliver hundreds of millions of ounces to meet institutional and industrial demand. Another misconception is that silver demand is dominated by retail investors. Retail participation is visible, but it is not decisive. The largest volumes are moved by industry, funds, and sovereign entities. These actors do not chase headlines. They operate on planning cycles. January aligns those cycles. When analysts say that January strength is seasonal, they often miss the mechanism. It is not the season. It is the synchronization of deferred decisions. December delays, January synchronizes. In a market under stress, synchronization produces movement. Risk management also changes at the start of the year. Losses carried from the previous year become more visible. Performance metrics reset. Managers are less willing to tolerate positions that could spiral. In silver, this can translate into forced covering. Forced actions move prices faster than voluntary ones. The size of the silver market amplifies all of this. Annual global silver supply is worth only a fraction of what trades daily in equity or bond markets. A relatively small reallocation from large portfolios can overwhelm available supply. This asymmetry is why silver often moves explosively rather than gradually. January 2026 also arrives after years of increasing awareness of supply chain fragility. The pandemic, geopolitical conflicts, and energy transitions have taught institutions that just-in-time systems fail under stress. Many industrial players have shifted toward holding larger inventories as insurance. That shift increases baseline demand and reduces the amount of metal circulating freely. When these factors combine, the result is not a smooth trend. It is a series of sharp adjustments. January is when those adjustments often begin because the system is forced to reconcile paper commitments with physical reality. This is why focusing on daily news is misleading. The most important drivers operate quietly. Inventory allocation, contract negotiation, risk reduction, procurement scheduling. These do not make headlines, they make price move. Silver entering. January 2026 is not entering from equilibrium, it is entering from imbalance. The question is not whether something will happen, but how quickly the system will acknowledge what already exists. Investors who expect January to behave like a normal trading month often misinterpret early signals. Strength is dismissed as noise. Dips are assumed to be reversals. By the time consensus forms, the adjustment has already occurred. The purpose of understanding these facts and figures is not to predict a precise outcome, but to recognize conditions. When demand accelerates into constrained supply, price must adjust. January accelerates demand. Silver constrains supply. The interaction is unavoidable. In the next part, the focus will shift to interpretation and strategy, how to distinguish real moves from noise, how to reduce fragility rather than chase momentum, and how to think in terms of optionality instead of prediction as the year unfolds. By the time January is underway, the most important decisions have already been made. Prices are not moving because investors are suddenly excited. They are moving because the system is adjusting to constraints it can no longer ignore. This is the phase where many people misread what they are seeing. They look for narratives, explanations, or confirmation from authority. But markets under stress do not wait for consensus. They move first and justify later. One of the most common errors during this phase is confusing volatility with instability. Volatility is not a sign that something is wrong. In constrained markets, volatility is a sign that price is finally doing its job. It is rationing demand. When silver moves sharply in January, it is not behaving irrationally. It is responding to the return of full participation in a system that was already tight. The speed of the move reflects how little flexibility exists, not how emotional the market has become. Another mistake is assuming that strong early moves must reverse. This belief comes from equity markets, where liquidity is deep and supply is elastic. Silver does not operate under those conditions. When demand enters a market with limited immediately available supply, the first adjustment is often the largest. Waiting for a textbook pullback can mean missing the repricing altogether. That does not mean price will move in a straight line, but it does mean that the underlying direction is being set by structure, not sentiment. January also exposes the difference between participants who can wait and those who cannot. Retail investors can afford to hesitate. Institutions often cannot. Industrial buyers have production schedules. Funds have benchmarks. Banks have risk limits. When these actors act, they do so because delay carries cost. Their behavior is not optional. It is mechanical. This is why early year flows tend to be persistent rather than fleeting. Another layer that becomes visible in January is the distinction between paper exposure and physical exposure. In periods of stress, paper positions can be adjusted quickly. Physical positions cannot. This creates a hierarchy of urgency. Those who rely on physical delivery must secure it early. Those who trade derivatives may try to manage exposure. But if physical availability tightens, derivatives eventually follow. January is when this hierarchy asserts itself. Investors often look for confirmation in official data releases. Those releases lag reality. Inventory reports reflect what has already happened. Lease rates, premiums, and regional price spreads often signal stress earlier. When those indicators remain elevated or worsen in January, it suggests that the system is not healing, it is tightening. Ignoring these signals because they do not fit a preferred narrative is a costly mistake. Risk during this phase does not come from owning volatility. It comes from fragility. Fragility is the inability to tolerate movement. Highly leveraged positions, narrow time horizons, and dependence on precise entry points increase fragility. January tends to punish fragile positioning because price moves before patience runs out. Reducing fragility matters more than maximizing upside. Optionality becomes more important than prediction. Optionality means maintaining exposure while retaining flexibility. It means avoiding decisions that force liquidation at the wrong moment. It means understanding that in structural transitions, outcomes can overshoot reasonable expectations before stabilizing. The goal is not to call the top or bottom. It is to avoid being forced out of a position by mechanics rather than logic. Another misconception is that institutional behavior is coordinated or deliberate. It is not. Institutions act independently, but under similar constraints. When many actors respond to the same pressure at the same time, the result looks coordinated even when it is not. January amplifies this effect because constraints reset simultaneously across the system. As January progresses, attention often shifts to explanations. Analysts look for catalysts. Media searches for stories. This is backward. The catalyst is the calendar interacting with constraint. Everything else is commentary. When silver moves without obvious cause, it is because the cause has been building for years and finally reached a threshold. The temptation during this phase is to trade aggressively. Rapid movement creates the illusion of opportunity, but aggressive trading increases fragility. The system-level advantage comes from alignment, not speed. Those who survive structural repricing events are usually not the fastest. They are the most resilient. It is also important to understand that January does not complete the adjustment. It initiates it. Once the system acknowledges stress, it does not immediately resolve it. In many cases, earlier moves establish a new range rather than a final outcome. That range then becomes the arena for further adjustment throughout the year. Misinterpreting the first move as the last is another common error. Psychologically, January challenges patience. Rapid gains tempt premature exits. Sharp pullbacks tempt panic. Both reactions are forms of fragility. Structural markets reward those who can tolerate ambiguity. The absence of certainty is not a flaw, it is the condition under which repricing occurs. Another risk is assuming that official intervention will restore normality. Sometimes it does, sometimes it does not. Interventions can delay outcomes, but they rarely reverse structural constraints. In silver, intervention cannot create supply. It can only influence paper behavior. If physical demand persists, price will adjust regardless of intervention. As the year unfolds, the early signals from January should be used to assess system health, not to forecast daily moves. Are physical premiums normalizing or remaining elevated? Are regional price differences narrowing or widening? Is volatility compressing or expanding? These questions matter more than short-term price targets. The larger context also matters. Silver does not exist in isolation. It sits at the intersection of energy transition, industrial growth, monetary uncertainty, and geopolitical fragmentation. January does not resolve these forces. It brings them into clearer focus. The market's reaction in early January often reflects how these forces are being prioritized by participants. For many investors, the most difficult discipline during this phase is doing less, not more. Avoiding unnecessary action is often the hardest choice when markets move quickly. But structural transitions are marathons disguised as sprints. The first acceleration is only the beginning. The reason January matters is not because it is magical, but because it removes excuses. After January, participants can no longer blame holidays, budgets, or year-end distortions. What remains is the system itself. Silver's behavior during this period is a signal of how that system is coping. If January strength is absorbed and sustained, it suggests that previous pricing was insufficient. If January volatility resolves into higher stability at new levels, it indicates acceptance. If volatility remains elevated, it signals ongoing tension. Each outcome has implications, but none require prediction to recognize. Ultimately, the question January answers is simple. Can the market meet demand at current prices without strain? If the answer is no, adjustment continues. Silver has been approaching this question for years. January is when it must respond. This completes the framework. Part 1 established why January reveals rather than resets. Part 2 explained the institutional and physical mechanics driving that revelation. This final part clarifies how to interpret what unfolds without becoming fragile or reactive. Markets under stress do not reward certainty. They reward understanding. What follows January will depend on how the system absorbs the pressure it reveals. But by the time outcomes are obvious, the opportunity to act without urgency has passed. January is not about excitement. It is about exposure, and silver is entering it exposed.